The RBA leaves the cash rate on hold. Let's have a look. Good afternoon, everyone. Florian here, and welcome to another episode of HeiseSays. Grab your stein of coffee because we have the first RBA cash rate announcement with our new governor. And what has she done? Well, she's kept the cash rate. Well, not just her, the entire board. We've got to remember, it's not just the governor, it's the board as well. They want to make that clear. They've kept the cash rate on hold, everyone. So a statement by Michelle Bullock, the governor. Monetary policy decision. So at its meeting today, the board decided to leave the cash rate target unchanged at 4.1%. And the interest rate paid on exchange settlement balances unchanged at 4%. Now, we are not really too surprised. Judging by the poll I put out this morning to viewers of the channel, we jump over here. We can see actually 38% of the 877 of you that voted since this morning said there would be an increase. 60%, the majority of financial gigachads, said hold, and 2% said cut. Let's have a look at some of the comments here. Rates to the moon, then cuts closer to the next federal election. Wildflower is hoping for a rather much more exciting Reserve Bank than I think we're going to get. I mean, it would be fun. Phil from Melbourne thinks it's been leaked. Ian is going up, up, up. Kick off the new governor's tenure with a bang. Make it exciting. Yeah, I don't think that'll happen. I think 60% chance hold, 35% chance hike, 5% chance they cut. Immigration's destroying the country. Not really. It's kind of the reason this country exists. Up. Rates have still got 1% behind the rest of the world. We need more rate rises, but we all know it's going to be on hold till 2024. It should be increased. Rates will go up after the October 14 vote, okay? After the referendum. I don't think that, well, I really hope that isn't factoring into their decision-making process. But I guess you never know, maybe. We'll see. We'll see what the statement says. Probably should increase, but I don't think they will. Hold or increase this time, then rise. Next, from Stephen. In the general news, playing a lot of potential rate cuts. Next year, I guess we need to price out the next generation as fast as possible. Increase. So some of the more interesting comments are calling for increase or saying we need one, but it's holding. Well, here you go. The majority are now of HeiseSays viewers or voters on the poll are now in line with the the Reserve Bank. It's taken a while. This is only the second poll we've got right. Interest rates have been increased by 4 percentage points since May last year. The higher interest rates are working to establish a more sustainable balance between supply and demand in the economy and will continue to do so. In light of this and the uncertainty surrounding the economic outlook, the board again decided to hold interest rates steady this month. This will provide further time to assess the impacts of the increase in interest rates to date and the economic outlook. Do you think this is written like in the same Word document? They just copy and paste it so they can reuse bits of it? I get the feeling. Inflation in Australia has passed its peak, but it's still too high and will remain so for some time yet. Timely indicators on inflation suggest that goods price inflation has eased further, but the price of many services are continuing to rise briskly, and fuel prices have risen noticeably of late. Rent inflation also remains elevated. The central forecast is for CPI inflation to continue to decline and to go back within the 2 to 3% target range in late 2025. Growth in the Australian economy was a little stronger than expected over the first half of the year, but the economy is still experiencing a period of below-trend growth, and this is expected to continue for a while. You could actually make the argument that we've had below-trend growth on a per capita basis since the GFC. High inflation is weighing on people's real income, and household consumption is growing weak, as is dwelling investment. How are we going to meet this housing target that Labor's hoping for? It's going to be tough, guys. Notwithstanding this, conditions in the labour market remain tight, although they have eased a little. Given that the economy and employment are forecast to grow below trend, The unemployment rate is expected to rise gradually to around 4.5% late this next year. Wages growth has picked up over the past year, but is still consistent with the inflation target, provided that productivity growth picks up. Returning inflation to target within a reasonable time frame remains the board's priority, and I'm assuming 2025 is a reasonable time frame. I mean, how long have they been not managed to keep inflation within their target range? High inflation makes life difficult for everyone and damages the functioning of the economy. It erodes the value of savings, hurts household budgets, makes it harder for businesses to plan and invest, and worsens income inequality. And if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates and a larger rise in unemployment. It almost feels like they're trying to scare us into not expecting inflation to be entrenched. That, it might be an interesting poll to see those of you that have lifted your costs for the future, or your fees or your charges, with the expectation that inflation is entrenched. To date, the medium-term inflation expectations have been consistent with the inflation target, and it is important that this remains the case. The recent data are consistent with inflation returning to the 2 to 3% target range over the forecast period, and with output and employment continuing to grow. Inflation is coming down and the labour market remains strong, and the economy is operating at a high level of capacity utilisation, although growth has slowed. So this is good. People that want to work can work. There are significant uncertainties around the outlook. Services price inflation has been surprisingly persistent overseas, and the same could occur in Australia. There are also uncertainties regarding the lags in the effect of monetary policy and how firms' pricing decisions and wages respond to the slower growth in the economy at a time when the labour market remains tight. The outlook for household consumption also remains uncertain, with many households experiencing a painful squeeze on their finances, while some are benefiting from rising housing prices. Substantial saving buffers and higher interest income. Yet we're seeing Australia's a two-class economy, if not more. But there's a greater divide between those that are reaping the benefits from the current situation as opposed to those that are not. And in some regards, it's generational. You've got older generations that are established, that have houses, that have savings, that actually have money in the bank that can earn interest. They're going to do better off than the younger generations that haven't managed that. So what's the lesson to learn there? Go financially independent and live a frugal life till you become a boomer. And globally, there remains a high level of uncertainty around the outlook for the Chinese economy due to ongoing stresses in the property market. And that's a significant factor for us here in Australia because you've got the international education market, which brings a lot of demand here for our local resources and housing, fueled by China. You've got natural resources that we're exporting overseas, fueled by China, and you've got other sectors, tourism also. In many regards, the Australian dollar is seen as a proxy for the Chinese economy, which I always thought was quite interesting. Some further tightening, they may lift the rates of monetary policy may be required to ensure that inflation returns to target in a reasonable time frame. So if we're naughty, they're going to up the rates again, guys. But that will continue to depend upon the data and the evolving assessment of risks. In making its decisions, the board will continue to pay close attention to developments in the global economy, trends in household spending, and the outlook for inflation in the labour market. The board remains resolute in its determination to return inflation to target and will do what is necessary to achieve that outcome, everyone. So there we go. Let's have a bit of a chat about this one. So once again, it looks like I do not have to bother updating my cash rate target chart in my slide deck here on my vMix, which is fortunate because I'm pretty lazy today. But there you go. The cash rate is on hold. The majority of financial giga-chads predicted this. 60% said it was on hold. The market predicted it. There are no surprises here. So we'll just have to wait and see. I think the real question is, is 4.1% the peak cash rate target for 2023? Will they sneak in another increase, or will we even get a cut? I can't see us getting a cut if the status quo just continues. As always, Thank you for watching. Like, share, subscribe to the channel. Let me know your thoughts and opinions in the comments. And thank you to everyone who voted in my poll. If you want to help out or if you want to check out other content, we've got HeiseBim and HeiseDoes. And if you're a fan and want to support us, you can on YouTube or Patreon using the referral links, buying Pocket Squares, or calling me if you need an architect. Take care. I'll see you next time. Bye for now.